Our next lightning talk is going to be on stablecoins, tokenization, and the Treasury imperative, competing in a 24/7 financial system. Please join me in welcoming Joaquín Ayuso de Paul, Chief Product Officer of Alphapoint.
Do you hear me? Yeah, perfect. Well, first of all, thank you for having me here. And I'm going to describe quickly what Alphapoint is. We've been in the market for 12 years already, and we've developed technology for exchanges to be able to launch their own exchange in crypto technology. We power very large exchanges, if not the largest of countries like Canada, Thailand, very large projects in the crypto exchange world in Colombia as well. And we now are launching our new adventure into the stablecoin arena. I'm Joaquín, I'm the Chief Product Officer, and I have been in the financial technology and crypto technology for over 13 years now. Originally started with a mobile payments company that integrated every processor from north to south of the Americas. And by then we're already fiddling with tokenization. And then I built a couple of neobanks. The last one I sold to Neum, a payments company where I built together with Prajit the first real-time settlement in stablecoins channel for MasterCard to be able to send millions of dollars daily to Singapore from Europe. And then right after that, joined Zero Hash, where I basically started building all the infrastructure that enable, for example, BlackRock and Securitize to receive major stablecoin payments in the billions, with tickets ranging from 500 million to onwards in the stablecoins to buy the BUIDL tokens. Right after that, I joined the advisory board of Lago, which was the precursor of Anchorage USDG. Sergio had a really great idea of building a consortium of companies building a stablecoin rather than a company running a stablecoin or issuing a stablecoin. So Lago was the precursor of what Anchorage just built with USDG. And then finally at Alphapoint, we're basically building the next step for all the businesses and financial institutions to be able to access to the stablecoins. Our step is towards Treasury, and I'll explain why very quickly. There is, it's supposed to work. Oh, there you go. So here's the thing, right? There is a structural shift happening today with the stablecoins, and there is three items that matter the most. And when we're talking about traditional finances, we still are talking about rails that have been in place for decades, and these rails bring issues like the lack of real-time settlements, the inability to have those rails working 24/7 during the week and the weekends. And it becomes a struggle to be able to move money across borders in the world. What stablecoins bring today is a real-time settlement model where you can move value between two different places in the world in real time. And that is disruptive for all the financial markets. And it's working 24/7, which enables the crypto markets, for example, to be able to operate without the need of stopping in the middle of a weekend. And it enables investors, for example, to access US Treasury tokens on a Saturday evening or on a Sunday evening when they want to hedge their position buying BUIDL tokens with Securitize, as we heard before. So the stablecoin rails are actually changing fundamentally how we're doing finances. I'm not talking about retail finances. We're talking about the backbone of the financial system. So before I adventure to the real meat of the presentation, I want to first tackle a question that everybody's asking in the banking world versus the crypto world. Like, what is the difference between tokenized deposits and what is the difference between stable coins? Tokenized deposits is a proposal from banks to be able to tokenized money that already is within the financial system, with the FDIC-backed deposit in a bank account under all the controls that the traditional financial system have. On the other hand, stablecoins address the ability to enable real instant liquidity 24/7 in any parts of the world. So while tokenized deposits allow you to digitize the value that you have in a bank account, in reality, when you're trying to do payments across the planet, stablecoins is going to be your mechanism. What I'm trying to say with this is that each one offers a function in the financial system, and both are going to coexist. There is no battle between them, and we'll see later how the tokenized deposits will enable the stablecoins to be able to operate in the financial system in a more cohesive way, and stablecoins are going to enable for the tokenized deposits to be spread more into the retail world. So how that future stack is going to look like. In the first layer, what we're going to see is the assets layer. So we're going to see tokenized deposits as stable coins. We're going to see RWA tokenization. We're going to see a raft of assets that are going to be issued in the blockchain, and we're going to be able to manage through custody mechanisms. There's going to be underneath an execution layer. And this is a very important one because it's the one that differentiates the traditional financial world to the stablecoins and tokenized world. It's this execution layer, it's all about programmability, and it's all about smart contracts. And it's what enables the management of all those assets to be automatic. Instead of having strategies being run by humans or semi-automated by humans, we're talking about fully automated strategies allowing you to optimize that liquidity. And then finally, you're going to have the access layer, which are all these APIs, the smart contracts, and connections to the other two layers that would enable the access to this liquidity. So basically, it becomes an orchestration layer, and it enables you to manage your liquidity in a seamless way, programmable way, and we'll see later why programmable is so important in the stablecoins arena, which also involves tokenized deposits. So it's important to understand that the winners on this battle are going to be the ones that start thinking how to operate in this way rather than how to embed this way in the traditional financial system. And we'll see later why I'm saying it. What matters is the outcome. What matters is the impact that it has to you as an institution integrating into this new world. First of all, the biggest outcome is liquidity optimization. While as before, you had days before you could move liquidity from one asset to another, you had to prepare strategies, taking into account holidays and weekends. You now have the ability to move capital in real time and move capital, convert this capital into specific assets depending on the strategy that you want to have. You want to have a heavy yield strategy for your capital. You want to have a heavy liquid strategy for your capital. When you're talking in this new paradigm, it's real time for you. This is going to generate new revenue models that before were not accessible for you. We're talking about generating yield models that you can then sell across to your customer base, spread capture, and you can even produce programmable flows into your treasury that allow you to capture more revenue than you could before, thanks to the speed and the programmability of the stack. And then you're going to have a very big impact in your operational on your operational side. It's an operational compression. It means that the settlement cycles become T0, right? So you're going to be able, as I explained before, to move that liquidity across the assets very quickly. So it's not about, this is no longer about incremental efficiency. This is about a substantial change on the balance sheet, a complete transformation of the balance sheet, because now you're going to be able to push things around instantly and programmatically. And the programmatically is important because of this. Programmable money without governance is just programmable risk. And everyone is selling the idea that just because you have smart contracts, that is going to solve the problem. What the reality means is that without embedding your policies into those smart contracts, that programmable treasury is going to have the same risk that you had before. What the programmability of your treasury means is that instead of running process-based controls, you're gonna be running system-based controls. These are less prone to mistakes. These are less prone to delays. These can work 24/7, and they're embedded in the actual technology. Therefore, you don't have to plug into your core, plug into systems to make things controlled. The controls are inherent in the system that you're running your liquidity with, right? So governance moves from human-based controls to program-based controls. And these smart contracts are the ones that are going to be able to define various limitations. To give an example, let's say that you have a treasury platform, our treasury platform, that it's wide level, so you as a financial institution can offer these treasury services in stablecoins to your clients. You can set up smart contracts that allow you to be able to control to what wallets those stablecoins can be dispersed to. You can control programmatically whether the wallets are associated with a KYC person or not, and therefore immediately limit that flow. Traditionally, you would have done that via APIs, monitoring procedures. With this new stack, it will be embedded directly into the actual smart contract who is operating the stablecoins directly. It gives you also real-time visibility. That's one of the benefits of the blockchain. Everyone has aboard us about how transparent the blockchain is. So you get it natively, which brings you to the fact that you're going to be able to trace every single movement from the beginning to the end. You can even track all the different stablecoins flows and see if the flows were tainted, if the flows went through venues that you didn't want those flows come from. There are many, many, many advantages of the blockchain technology that are, of course, inherited into this stack. And you can have a counterparty and asset risk, understanding collaterals, issuers, and smart contracts exposure. You can see on the other end what's going on with those assets that you're being handled with. But the competitive reality, the real question, right, is what happens if you don't do this? And this is not about being easy. It's about being disintermediated. I have to practice that word. Let's put it this way. If your clients are moving money instantly, access yield natively, and settle without you, then you're no longer in the system. You're just a step into it. So institutions will treat Treasury as a strategic capability built for real-time liquidity. So adopting this new stack will allow you to be the system that the customers run, because everyone wants to do real-time settlement. Everyone wants to be able to pay instantly in the other corner of the world. Everyone wants to be able to access to yield directly. There's no question about that. And if there is something that offers a lower friction barrier to access to those, your customers are going to go to those places. And they already are. They're going to Coinbase. They're going to exchanges, Kraken, Circle. They're trying to figure out how to get the advantage of this new world. Financial institutions need to be cognizant of that. And they need to start thinking, how can we get to use Treasury in the stablecoin world as we use it in the traditional world? How can we get our customers, how can we offer our customers that very same treasury system they have with us for their own money, fiat, with the stablecoins, with tokenized RWAs, with tokenized deposits? So the shift is in this. Governance moves, sorry about that. So everyone else will be competing or on a shrinking layer of the stack. And I'm going to leave you with this, because I think that I'm done. The question is no longer if you should adopt stablecoins or tokenization. You've seen in this conference the vast difference that these new technologies produce, not only for your customers, but also for you. It's about who owns the flow. And today, banks own the flow of the traditional financial system. But that is shifting towards new infrastructure, new rails, new layers. Securitize just showed you one of the many rails that these flows are migrating to. It is important as financial institutions to understand that the sooner you get, and it's not about being the first, it's about being integral with your strategy. The sooner that you get into this new world, the better it's going to be for your customers to stay with you and use you instead of going to these new rails. And it basically accrues to institutions that can control the movement, the timing, and the logic of money. And that is Treasury. So it's not a technology shift, it's a control shift. And that was it. Thank you for listening.